It is my opportunity now to introduce the panelists that we have speaking with us for the next hour, and I'm certainly very much looking forward to this discussion. I'm joined by His Excellency Dr. Bandar Hajjar of the Islamic Development Bank, James Talbot of the Bank of England, Leonie Schreve of ING Bank, and Dr. Barbara Buchner of the Climate Policy Initiative. I'm keen to jump straight in because I know we've got a lot to say on the topic this morning, and I'm going to start with you, Barbara. We're all aware that to avoid and adapt to climate change, we need to redeploy capital towards financing a zero carbon and resilient economy. Can you please set the scene for us by sharing some of the insights of your work that's been estimating and tracking climate-aligned finance flows?
Absolutely, and thank you so much, Rhian, for having me. Thank you so much to the organizers for having me here. I'm very happy to get us started and look forward to a very rich discussion here. So my organization, Climate Policy Initiative, we started tracking climate investment in 2011, and since this time, we have seen steady increases in financing for climate action. In fact, climate finance flows crossed the $500 billion mark for the first time in 2017 and in 2018. And this trend is consistent both globally and in important national contexts. We just released a study that shows that green finance in India was also increasing pre-COVID, and that in fact its increase was outpacing the country's GDP growth in the period between 2016 and 2018. What we've also learned is that finance from institutional investors and smaller funds increased in our latest landscape report threefold, and we also saw commercial financial institutions playing a more important role than ever, increasing finance by 51%. So these trends indicate a broader move within the financial market to sustainable industries, but much more is needed. In fact, while these upward trends are very encouraging, we are falling far short of what's needed for a successful low carbon climate resilient transition. There's a huge gap between the roughly $500 billion annual flows and the needs. And while we don't have perfect and comprehensive numbers on the global needs, we have seen that the IPCC has identified a 1.6 to $3.8 trillion annual need for the supply side energy system alone. And if we look again just at one country, at India, we know that the money that's flowing there at the moment is only about 10% of what's needed to reach the country's climate goals. So just a final point I'd like to make, Rhian, before passing back to you, is that financing of high emissions assets and maladaptation really must be phased out rapidly. Right now, average annual finance for fossil fuel upstream and downstream supply infrastructure are about $800 billion, and that's more than triple than what's being spent on clean energy. And if funds continue to flow towards fossil fuel projects at such a massive scale, then we'll lock in high carbon assets. So it's fundamental to continue to phase out investments across the fossil fuel supply chain, not just in power generation. So in a nutshell, I think we've seen lots of positive trends, but we need a clear change of gear, and it's urgent. But just coming back to the kind of introduction to our panel, I think I'm an optimist as well, so I know we can make it happen. I look forward to hearing more from other panelists on the how. So back to you, Rhian.
Thank you so much, Barbara. So some very encouraging statistics there, but also a clear call to action because we're seeing these huge gaps. And so I guess over to you, James, as to how do you view the role of the regulator supervising us in catalyzing climate action amongst the financial services firms that you're responsible for supervising?
Well, thanks very much for that question. And just to echo what Barbara said, it's really great to be here today. So essentially, the role of the Bank of England is, we need to regulate and supervise one of the largest banking and insurance sectors in the world. And so in doing that, we not only need to make sure that the individual institutions that we supervise are safe, but also that the system as a whole is safe. And I think what we've come to realize over the last few years is that climate-related risks can impact the financial system through a number of channels. Let me pick out two. First of all, physical risk associated with climate change. We're seeing wildfires, floods. These things have real economic impacts. And one only needs to think about the role of insurance companies in that. They need to insure against those risks, but there are many other things as well. Secondly, there's the risk posed by the economy-wide transition that we need to make to being carbon neutral. For example, the banks we supervise may have credit exposures to companies whose business models may not be aligned with that transition that we need to make. So in response to this, really, I think what we're trying to do at the Bank of England is to build a UK financial system that's resilient to the risk from climate change, but is also able to support the transition to a net zero economy in the UK as well. And indeed, we've made this one of our strategic priorities right now. So in order to build the resilience I've spoken about, we essentially need to ensure that individual firms are able to proactively manage, preemptively reduce the risks that they face from climate change. So let me just pick out a few things that we've done over the last few years. So the first is that in 2018, we surveyed all the banks that we supervise, and we found something really quite interesting, which is that only 10% of those banks at that time were taking a strategic approach to managing climate change, thinking about the long-term impact on the firm. So last year, in light of that survey, we produced some supervisory expectations for the firms that we supervise. And what we asked them to do is essentially to manage the financial risk from climate change. And this covered areas like governance, risk management, scenario analysis, and disclosure. We then followed up on this in the summer of this year. The head of the PRA wrote to all the CEOs of the banks that we supervise. And in that letter, we provided some observations on good practice. We set out next steps for implementation. And we basically made clear that we expect the firms that we supervise to implement these things by the end of next year. But I think, as I said at the beginning, ensuring that the individual firms are resilient isn't sufficient, and we need to look at the system as a whole. So next year, we're going to try and move even further forwards. In 2019, in our insurance stress test, we started to incorporate an exploratory climate scenario to think about how that would affect things for the insurance sector. But next year, what we're going to do is we want to go further by testing the resilience of banks, insurance companies, the linkages between them, and also the financial system as a whole. And so we'll do a stress test, essentially, of the individual firms and the system to basically provide a comprehensive assessment of the UK financial sector's readiness and exposure to climate risks. What are we trying to do there? Well, essentially, I think we're trying to size the exposures that participating firms have to climate risks. We're trying to understand the challenges to business models that these firms face. And we're also trying to assist the firms that we supervise in enhancing their management of climate-related financial risks. So I think in doing this, we'll be the first central bank to undertake a comprehensive stress test of this sort. We published a discussion paper which sets out more details for those who are interested at the back end of last year. And we're pretty pleased, actually, that since putting that discussion paper out, several other central banks have also decided that they're going to do something like this. So let me finish just by saying that as well as all this domestic work, the Bank of England is very active internationally, both in terms of pressing for greater consideration of the sorts of issues we're talking about today, but also through our participation in groups like the Network for Greening the Financial System, which we're a founder member of. And now there are over 70 members, which is absolutely fantastic. But also through our engagement at standard setting bodies like the Basel Committee and also at the Financial Stability Board. Let me stop there. Thank you.
Thank you, James, and thank you to all at the Bank of England for the leadership that you really are showing on this agenda. Easy for me to say that. I'm interested in how one of the banks that you supervise would like to respond to all these regulatory developments. Leonie at ING, how are you integrating climate considerations into your financial decision making in order to channel more capital towards zero carbon economy of the future, and also to mitigate against some of the risks that James has outlined?
Yeah. No, thank you. And indeed, first of all, thank you also for being part of this panel and the conference. So looking forward to our discussion. And I think James also put it rightfully there that on the one hand, you really need to have a very strong supervisor. You need to also have very strong regulations. And you see that that is happening from the central bank side, but also from the European Commission side, that from the regulatory perspective also governments are stepping up. But of course, the private sector and the financial sector on its own has its responsibility as well. And it is always a joint effort there that we can accelerate the fastest when we need to address the climate crisis. So what we've seen also the last couple of years, that in particular sustainable finance has grown significantly. So we've seen on our portfolio that year on year, we've almost seen doubling of our portfolio. And you see that it is really on top of our clients' agenda. Despite even the current situation, you see the market still growing. But one of the commitments that we've made, of course, we've made our commitment to TCFD, but we've also made our commitment towards what we call Terra. And Terra is the approach where we've said we want to align 600 billion of our own lending book in the most high-intensive sectors towards the Paris Agreement. We teamed up with 2° Investing Initiative, developed an open source system so that also other banks and financial institutions can join us in using the same methodology. And per sector, we are looking at what is the trajectory where the market is standing today and where it needs to move towards when it comes to Paris alignment, and that we've mapped on our portfolio. Last year already, for a number of these sectors that we cover, we've published a progress report, and unfortunately this conference is just too early because in a few days' time we'll publish our second report where we'll share an overview of where we stand when it comes to all the different sectors that fall into our Terra commitment. So by doing that, we can actively see where does the ING portfolio stand today and where does it need to stand tomorrow. And that will help us in dialogue with clients and specific steering mechanisms, also specifically structuring certain transactions. For example, if an automotive company is not yet at the benchmark where we want it to be, then we get into a dialogue and see if we can accelerate by specific financing their electrification fleet. So there are those kind of ways where we as financial institution can engage in a dialogue with those companies that play a role in accelerating our climate commitments and really making sure that together we make that happen.
Thank you, Leonie, for really bringing this to life with some really practical examples of how you're operationalizing this. You did allude to the current situation, and I think clearly any discussion that we're having at the moment about investment in climate outcomes, it does need to take place within the context of the public health crisis and the economic turmoil of the COVID-19 pandemic, which leads me to address a question to Your Excellency, Dr. Hajjar. How do you view the challenges of aligning investment to support climate outcomes whilst supporting recovery and economic growth in response to the global pandemic? Your Excellency, you may be on mute.
Thank you. It gives me great pleasure to join this important discussion panel today. And the scale of COVID-19 outbreak demonstrates that we are not prepared for large-scale pandemics. And it exposes the lack of resilience of increasingly highly connected world. And it is probably not going to be the last. So the storm will pass, but choice we make today will change our lives. So we need really to do development differently. Most of our member countries, 57 member countries, have severely hit by reduced income activities, collapse in oil and commodity prices, fall in remittances and tourism, as well as trade and supply chain disruption. Even before the pandemic, our member countries were facing a range of climate-related issues, such as poor water and sanitation, shortage of clean energy, global warming, and vulnerability to environmental disasters. Our response was a launch of a well-planned and fast-tracked program with a total envelope of $2.3 billion. We call this package 3 Rs: response, restore, and restart. The three tracks cover short, medium, and long-term measures to build resilient economies, to achieve transparency and efficiency in delivering the ISDB aid to member countries. And we have created online country platform based on blockchain technology. The platform is focused right now on the medical supplies and food items, and it will open soon for investors who are looking for AAA trade transaction. The program involves long-term action to build resilience, and it is also balanced with the new ways of supporting climate outcomes. For example, in November 2019, the ISDB issued green sukuk, which is bond, amounting to €1 billion to finance a range of climate change and green projects in 57 member countries. And this issuance was the first rated green sukuk in global capital market. The proceeds were earmarked for the ISDB project in renewable energy, clean transportation, energy efficiency, pollution prevention and control, clean water and water waste management. Also in June 2020, the ISDB launched the first sustainable sukuk to raise $1.5 billion from a wide range of investors to finance projects in member countries. These were the first of its kind sukuk related to pandemic in the global capital market, and the proceeds will be used in economic and social projects to improve health facilities, equipment, and critical staffing in member countries to mitigate the effect of COVID-19, as well as to support medium-sized business to promote and promote employment. So I will stop here. Thank you.
Thank you very, very much. And I just wanted to congratulate you on your green sukuk bond, and also make the point, we've obviously got a really international panel here today, but the London Stock Exchange is one of the leading issuers of green sukuks, I think over 66, and have been issued to date, and that's over $50 billion. And therefore, you know, many thanks to you and to our colleagues at the London Stock Exchange for promoting this asset class. Leonie, I just want to come back to you, if I may, about how you're seeing the COVID-19 pandemic and the turmoil it's causing. How is it impacting the climate finance and sustainability agenda for your bank's clients? What trends are you seeing?
Yeah, as I mentioned, I think the sustainability has really proven to be an item to stay and not a trend. So we see our clients really still very eager in engaging in sustainable finance transactions, putting the topic high on the agenda. And what we've seen, I think, only the first couple of weeks of the pandemic, when the whole world went in lockdown, we've seen a bit of a slowdown and a bit of a wait and see mentality, and securing liquidity as first priority. But immediately after, we've seen the bond market taking off again on the green side and on the social side. And one of the interesting things there was as well that we were able to also use and utilize sort of the needs to address the challenges of the pandemic into incorporating that into our green finance products by also structuring COVID-19 social bonds. So we've supported a number of, and I think 4 social COVID-19 bonds so far, in really supporting our clients in addressing immediately the challenges of the pandemic by accelerating investments in healthcare, for example, in social housing, in unemployment, all those kind of things to really help address the challenges of the pandemic. But I think maybe more importantly is also that we've seen this whole sort of sustainability discussion being very much alive when it comes to government approaches, part of the support being given also linked towards specifically accelerating on green or social ambitions of clients. Also the Green Deal, where we've seen even a more strengthened approach being proposed. And of course also continued growth of our business. We as ING also issued statements like building back better, really focusing on, if we look now at our clients, can we use this situation as well to look at, can we combine economic restoration with accelerating green economic growth? So in that sense, I think the topic is high on the agenda. It is very much on the radar, and you really see that there's a drive to see what can we learn from this crisis in helping accelerate the challenges that we have when it comes to social sustainability and as well with climate sustainability.
This is really encouraging news that we're hearing from our panelists about the continued importance of climate alignment and sustainability despite the turmoil that we're seeing. Also, hearing about COVID bonds, hearing about green sukuk bonds. I'm really keen to talk more on these examples of specific financial mechanisms and partnerships that we're seeing that are practically deploying capital towards climate outcomes. Maybe if we come to you, Barbara, I mean, through the work of your Global Innovation Lab for Climate Finance, you've been developing some of the financial instruments needed to mobilize capital. Could you share some of those exciting innovations that you've been helping to develop?
Absolutely, very happy to do so. And again, I think we certainly need the innovative business models and financial instruments that can really leverage initial government and development money to enable private investment and scale. I think this was also one of the insights from the previous panel. And again, one example to come up with these types of solutions are public-private initiatives such as this Global Innovation Lab for Climate Finance, which we manage. So very briefly, just what is the lab? The lab is a public-private initiative of experts in sustainable investment, both from government, from development finance institutions, from investment banks, institutional investors, and other private sector institutions. And its goal is to unlock private investment in decarbonization and climate resilience at scale. How does it do that? It does that by crowdsourcing, developing, and supporting the launch of new solutions that tackle the barriers in the market and really attract investment. And just in a nutshell, since the lab started in 2014, it has developed and launched 49 financial instruments in business models that have mobilized more than $2 billion for concrete projects in emerging markets. So I think this is an exciting example of an incubator or an accelerator that works, also thanks to the partnerships and the collaboration between the public and private sector. We currently have, out of the 49, over a dozen of instruments that are lab endorsed and projects that are actually shovel ready, meaning that they're really able to leverage immediate funds into action on the ground and help a sustainable recovery. And maybe just as one example, and again, I could share many more during the discussion later, but as one example, let me just introduce you to CRAFT, which is a growth equity fund that invests in climate resilience technologies that have demonstrated market demand and revenue. So the fund helps companies like weather analytics or catastrophe risk modeling services to expand in the new sectors and geographic markets that are tackling COVID-related issues such as disaster response and supply chain resilience. And just maybe to mention, at the end of September, just a couple of weeks ago, the lab announced its 2020 class of instruments, which have specifically focused on tackling this twin challenge that we've heard about already in this discussion here, the twin issues of climate change and economic resilience. And we'll have an investor demo day on October 22nd that will really briefly introduce the whole selection of interesting lab instruments which are ready for expansion and implementation. So very much hope that we'll be having many of you join that day, and I certainly welcome every one of you and invite you to be part of that and learn to get to know more of the financial instruments and business models that we have developed. Back to you, Rhian.
Thank you. And so your investor demo day again on the 22nd of
October 22nd. Yeah.
Fantastic. Invitation to all of those on the line. Moving on to Dr. Hajjar, what's your view on how we can create partnerships and financing mechanisms that could attract new types of investors. And particularly picking up one of the questions that we've received online is whether you could provide further examples of ethical finance instruments that are driving growth and empowering some of the more marginalized communities through innovative partnerships.
Okay, the scale and magnitude of challenges facing the world in general and developing countries in particular are beyond the capacity of any individual governments or institutions. And this is why the Islamic Development Bank is adopting a new business model centered around playing the role of catalyst for development and transforming the bank from development bank into a bank of developers. Developers means public-private philanthropist people partnership. So we have 5 Ps. And from on balance sheet funding provider to development enabler and market creator. So the new business model aims to make market work for development, to make market work for the poor, for women, and other marginalized group. Here I would like to highlight just few examples. The innovative One Wash Fund, which is we announced in the UN General Assembly in September 2019, will attract the ESG investor to fund $180 million program for cholera eradication, and it will target 5 million people and enable 26 Red Crescent and Red Cross societies to carry life-saving work. Also, we have launched an innovative fund with UNICEF called the Global Muslims Philanthropy Fund for Children that open a new opportunity for Muslims philanthropy to reach 89 million children currently in need of humanitarian support. And the fund will enable partners to provide many more of these children with access to safe and clean water, nutrition, education, health protection. So the unique design allow multiple forms of Muslims philanthropy, including obligatory giving such as zakat and voluntary giving such as sadaqah, donates, and waqf endowment to contribute emergency response and development program. And by the way, dinar standard estimated the global zakat at $76 billion in 2019, and ISDB calculated the global zakat to be worth of $1 trillion per year. So zakat as one of the 5 pillars of Islam, so it needs to be better captured and channeled to respond to SDG.
But may I ask you, thank you for that, may I ask you a further detailed question, which is coming from one of the viewers, Mr. Burhan Ali, about whether you see a potential for conventional ethical banking to integrate with Islamic financing, because apart from the Sharia screening procedure, that the fundamental principles are almost identical. I guess what we're asking is, is there a case for alignment? Are there other lessons to be learned that we could take from Islamic finance?
Yeah, Islamic finance is worth of $2.5 trillion. And this is in 2018. And it is due to exceed $3 trillion in 2020. Further projections show that Islamic financing instrument will continue growing, driven by the high population growth. The global Muslim population is expected to grow from 1.7 billion in 2015 to 2.2 billion by 2030. And 66% of Muslims consumers are willing to pay more for ethical products, according to the State of the Global Islamic Economy report published in 2019. So there are also Islamic financial products and services in 50 Muslims and non-Muslims jurisdictions worldwide, spanning Malaysia, Dubai, Bahrain, Great Britain, so ISDB, Luxembourg, and others. ISDB leads the global development community on the Islamic finance and is the center of excellence when it comes to developing Islamic financial instruments. Also, it is at its core, Islamic finance is in the basic tenets of Sharia and has the principle of sustainability, fairness, equality, Sharia compliant investment, all investments that are good for communities and do not cause harm. Because Islam promotes social trust, cooperation, solidarity, and governance factors that are increasingly taken into account by financial institutions to ensure a responsible investment by measuring sustainability and social impact of their investment. All these features give this model its true universality. So we view Islamic finance as a form of ethical and sustainable investment in general. So we don't look at, when we look at the conventional finance and Islamic finance, they complement each other. And we see, for example, in the last few years, since 2005, the Great Britain, the first Western countries that to issue sukuk at that time was $250 million. And then they start also to develop the regulations and rules of the financial market and of the banking in order to adapt it to Sharia and to become Sharia compliant. So now when we talk about Islamic finance and we are talking about conventional finance, we are in fact talking about common principles and values and how we can really generate an instrument and financial product based on these values. And the world now we have, as I mentioned earlier, we have a common value between us.
Thank you very much. And this idea of aligning conventional finance with more purpose-led finance, I think is something that gives us all optimism as we look to trying to mainstream the sort of purpose-led, climate-aligned finance that we're all striving to support. We've had a very optimistic half an hour discussing a lot of innovation and opportunities to invest. I do want to bring it back to climate risk, however, which is obviously a key and important thing for us to discuss. James, I'm going to come to you with this question of, with the frequency and severity of natural disasters intensifying, I think you mentioned earlier, should climate risk be viewed as this cohesive theme that may permanently weaken the capacities of affected regions or certain sectors to recover? Is that the right way to look at this?
Yeah, I think it could be actually. So when we've thought about this at the Bank of England, I mean, our sort of two primary responsibilities are to maintain monetary and financial stability for the UK economy and financial system. And I talked a little bit earlier on the financial stability side, but let me talk about the sort of economic stability side. And I think when you think of climate shocks, a natural disaster, a severe weather event, it's very difficult actually to think of a part of the economy that doesn't affect. It affects households. There's a sort of wealth effect for consumers if their property is destroyed. It affects businesses, it creates uncertainty for businesses, which affects investment. And then, of course, one thing we're particularly interested in, as I was talking about earlier, is how it affects the financial sector. But I think the sort of point of your question is not just those effects, but also the potentially more long-lasting effects. What we economists call the kind of supply side of the economy, and how climate events will affect that. So let me just draw out 2 or 3 points on this. I think, first of all, in a country like the UK, it's pretty tempting to think of extreme weather events as being something that happens somewhere else in a faraway country. But actually, as we all know, the UK is a very open economy. A lot of our economy is dependent on trade, and generally that's an extremely good thing. But it does also mean that extreme weather events or climate-related events in other countries matter an awful lot. Just to take a couple of examples, in 2011, we saw the floods in Thailand, which created global shortages of automotive components, disrupting global car production. Just 2 years ago, we saw the extreme drought in Germany, causing water levels in the Rhine to fall so much that supplies of fuel and other commodities were pretty severely disrupted. And there's pretty obvious impacts on consumers here in the UK from both of those things. Secondly, we know that natural disasters have a sharp downward impact on GDP at the time that they occur. And I think the academic literature is quite open in terms of how persistent these effects are. Some papers say you get a bit of a boost from kind of building back after a disaster, but others, and I think there's definitely evidence to show that actually these effects on GDP and growth can be a lot more persistent than we think. There's a nice study that was done in 2014 that looks at the effects of more extreme cyclones over a 60-year period, and that shows that in a lot of those countries there's persistent effects on GDP 20 years after the big cyclone first happens. Which brings me to my sort of third point, which is essentially that it can be tempting sometimes to think of climate-related shocks as being one-off events, but I think there's sort of increasing evidence that these are not one-off events anymore. Just to give some statistics on this, total global economic losses from disasters between 2005 and 2015 were more than 1.3 trillion US dollars. And that's up from less than $500 billion in the 10 years from 1980 onwards. And I think that shows that these impacts are increasing, that they're becoming more persistent. And I think, in the economics profession, we need to do some more work on this to properly model this. In the central banking profession, we need to think about how this affects our economic forecast. But I think what I would say is that, these effects are potentially big enough to affect GDP growth. And then as a policymaker, that's when we become interested, because that becomes meaningful from a policy perspective. If I can just finish on perhaps a slightly cheerier note, though, because that was quite doom-laden, I think. I would note that if we think of the other side of climate risk, so the transitions that we need to make to net zero, actually this could be an opportunity to invest in new technologies. And also, when we think about what's going on at the moment, and you talked about the effects of the COVID shock earlier, to the extent that we need to boost demand as we come out of this shock, that's quite consistent with the need to invest to achieve our climate goals. So I just wanted to end on a sort of slightly more upbeat note there, if possible. Thank you.
Yeah, thanks for that. Leonie, I guess same question to you. I mean, we've heard this sort of policy and economic outlook. How about as a practitioner from a banking perspective?
Yeah, I think the climate risk is becoming a significantly important area for the bank, in how not only on how we have our discussions with clients and help them on their transition pathways, but also looking at how does our portfolio look like. And I mentioned our Terra commitment, where we already look at what is the pathway to transition towards the Paris Agreement, and how do sectors that have significant impact today, how do they technologically need to change to meet the Paris Agreement. So that is an angle where we can steer on, how we can measure and monitor our portfolio also. Is it going the right direction? And of course, in individual client discussions. But I think one of the interesting areas of climate risk is also that it has become a much more mainstream area. And while a couple of years ago it was still very much seen as a topic which was covered within environmental and social risk management, where you had policies on do no significant harm, which sectors are you not involved in, etc. It increasingly becomes an integrated part of decision making on which sectors do you support going forward and who are the parties within those sectors that are playing a leading role, have significant commitment, and that we want to indeed work with to transition further. So I think that is an interesting area where you really see that sustainability and in particular climate risk is becoming part of mainstream steering of the bank where we're going to head for. And you see that as well. An interesting example, I think, was last week when, and Barbara, maybe you can also further allude to that, is that the Californian government also announced that they will not allow selling combustion fuel cars anymore after 2035, because they don't want to have the cars influencing the air quality that has become already so worse now because of all the fires. So I thought it was also an interesting area where you really see that there's not only there's really a push across the globe that climate risks are becoming prominent and need to become mainstream in how we steer our economy.
Thank you, Leonie. Barbara, if you would like to comment on any sort of California policies, we'd be delighted to hear from you, given that you are sitting in San Francisco. It's very early in the morning. Thank you for joining us from there. But if you would like to just pick up on some of Leonie's points, that'd be great.
Yeah, yes, just to say, and just to add to that, I think thanks, Leonie, for raising that. I think, you know, me as an Austrian, like living here, California, didn't expect to have climate change really at, you know, my door, basically. I think we have been here really suffering from the implications of wildfire, but it has increased really the overall public awareness on the needs to mainstream climate risk into decision making. And it has really kind of led to some of these regulations. I think the state of California really is going into the right direction by exactly making sure that we are phasing out some of these, you know, the high carbon assets, and making sure that this is something that really allows the societies to basically gain back better. So just to say, I think this is the beginning. I can see much more interest actually in, and also California has just become part of an initiative that Willis Towers Watson is leading on climate resilience, the CCRI. So I think there is a real awareness here that climate change is not something, as James said, it's far away from everyone, but it's something that we need to tackle now, and we can only tackle that by really making sure that we're mainstreaming climate risk into daily decision making. So maybe let me just stop here. But yeah, the air quality is better today, I think, which is good. But we've been like not able to go out for weeks now, which has been really challenging.
Wow, challenging and terrifying, frankly. When we discussed earlier the topics that the panelists really wanted to chat about, one of them was around transparency and disclosure of climate risk. So obviously the TCFD has now over 1,440 supporters. That includes all the systemically important global banks and most institutional investors. But capital markets today are still not fully pricing climate risk. And that was something that we wanted to discuss. Maybe James, you can start us off. How do you view the role of the regulator in helping financial markets to more accurately price climate risk? And what's the Bank of England doing to promote transparency, disclosure, and the other steps needed to promote that accuracy?
Yeah, thanks. I think this is a really important question, and it's an area the Bank of England's done a lot of work in, particularly internationally over the last few years. You mentioned right at the beginning the TCFD, and going back to 2015 when the TCFD started, the G20 asked the Financial Stability Board, which was chaired by our governor Mark Carney at the time, to look into this, and Mark then started work with the private sector on TCFD, which I think has really brought us a long way in the last 4 or 5 years. the aim really, I think, from our side in thinking about this was that the TCFD's recommendations would be adopted as widely as possible. And really, that's just so that investors and companies have sufficient information to understand the effects of climate change. And that comes back to some of the things we were discussing earlier in the panel. Rhian-Mari, you mentioned at the beginning that signing up to TCFD has really increased in the last few years. And as you said, there's now a very large number of companies globally. To add one fact to the facts that you had, I think we've got asset managers and wealth managers with a market capitalization, with assets up to around 150 trillion under management that are now signed up to TCFD, and I think that's a real achievement. I think from our side, in terms of the regulatory perspective, we've been pushing UK banks and insurers to try and make progress on disclosure through some of the work that I was talking about earlier in the panel. And we and the Financial Conduct Authority have also been working with industry through the Climate Financial Risk Forum to try and get a practical guide for how companies can work through these issues. But I think the thing I would say is that despite these efforts over the last few years, there's more that we need to do, both in terms of the quantity of disclosures and also the quality of disclosures. I think there's also a role here for government as well. Some countries are considering what role they can play. And as you'll be aware, the UK's Green Finance Strategy sets out the government's expectation that all listed companies and large asset owners will disclose in line with the TCFD recommendations by 2022, which I think is a hugely positive step. And we've been part of a cross-government task force, again, with our other colleagues. And that's been set up to think about the most effective way to approach this question on disclosure, including thinking importantly about this question on mandatory reporting. And actually the FCA have already consulted on requirements for commercial companies with the UK premium listing to disclose against TCFD on a comply or explain basis, again, which I think is a big step forward. But the final thing I'd say here is that as ever, we look for international coordination in this space, and that's because we want a consistent approach across countries. We want to avoid fragmentation. And I think really keeping TCFD at the heart of climate reporting is key to ensuring consistency in this area. And perhaps just one final thing from the Bank of England's perspective, and very close to home, we're also doing our bit, which is that we ourselves became one of the first central banks in the world to publish a comprehensive TCFD aligned disclosure of our own operations this summer, which spans both our physical activities, for example, the production of banknotes and things like that, but also our financial activities, including the asset portfolios that we hold. So I think this shows that everyone can do their bit really, and the more people we can get signing up to TCFD, the better. Thank you.
Well, and thank you. I just want to quickly ask a question that's come in from John Holland, University of Glasgow, if I may, James, which is, of the top 10 financiers and 10 companies producing highest emissions, what legal sanctions exist to stop them now? And I just wanted to get your comment on that particular question very quickly.
Well, it's not particularly my area, this. It's more a sort of an area for government, I think. I mean, maybe if I can just mention one thing that the bank is doing, which is related to this area, which is, I mentioned earlier that we have various operations that we do in financial markets. And generally, when we do those operations, we try and take a market neutral approach. But I think if it's clear that the market isn't accurately pricing these climate risks, as we were discussing earlier, and as I think other policymakers like Benoît Cœuré at the ECB have mentioned, then you really need to look at your operations. And even if you think you're taking a market neutral approach, it may not be neutral in the climate space. So that's something we're looking into. Obviously, this requires agreement from the Treasury, who set our mandate, but I think that's one small area where central banks can be involved. And I think perhaps the question that you pose is more one for the government. Thanks.
Thank you, James. The one thing I would say is, as chair, offering my own view here, but whilst we are talking about regulatory intervention, there are some very interesting stats coming out of Goldman Sachs just earlier this summer about how we are starting to see some divergence in the cost of capital for oil and gas investments versus renewables, which is really leading to structural constraints in new long cycle oil project investment. It's down over 60% in the last 5 years versus the previous 5 years. And according to Goldman statistics, CapEx, capital expenditure on low carbon transition initiatives nearly account for 50% of the big oil majors' CapEx as a running total now. So, I mean, that's the most optimistic data I've seen in a long time about the actual markets trying to resolve this issue without even further legal or regulatory intervention, which clearly, you know, given the urgency of the task at hand, I think we need to actually look at all possible interventions. Anyway, sorry, enough from me. I wanted to speak to Leonie about, in addition to TCFD, what other regulatory and market developments do you think will help in creating more transparency so that the capital markets absolutely fully and accurately price climate?
Yeah. On the one hand, I think the European Commission, the EU taxonomy will help because it provides additional disclosure and transparency in the market of what is the percentage of activities that our clients are doing in the well-defined eligible green categories of the taxonomy. So that's one area, at least what makes it visible on how are you performing when it comes to defined green activities. On the other hand, I think also besides the regulatory perspective, you also really see already the market perspective. When we started in end 2012 to really incorporate sustainability into our commercial strategy for our investment bank, the wholesale bank, we did that partly on the basis of belief sustainable business is better business. And we did also research in looking at what how does a company that has a high ESG rating, how does that is that reflected into its credit rating? And you saw already that both if you have a high ESG rating and you have a good credit rating, that those often are in combination. So that would automatically already mean that you would be able to attract better funding. Of course, it's always the question of, is it just a well-managed company and therefore you take sustainability into account? It's just an indicator that at least shows that it is an important element of it. And in my opinion, it is definitely such an element. On the other hand, you see also now with investors, and that's partly will increase by the regulatory developments, that access to funding, green becomes a much more critical element to it. You see investors reading their mandates, you see that with mainstream investors, you see that with purely green investors. And if you develop a transaction, structure a transaction, put it on the green market with access towards the green investors, so a green bond, for example, then you'll have access to many more investors than the traditional investor market. So that also enables you to have quite a dynamic pricing mechanism and often helps you also to tie in pricing quite a bit and have cheaper funding on the market. It's not a given, but it is a factor that becomes a more important role, plays a more important role going forward. And already you see the signals in the market at this moment that access to funding will require further addressing sustainability elements.
That really is encouraging. Thank you for that. I just wanted to throw in another question that's come in from the viewers, which I thought was quite amusing, which is, can the finance industry unite to tell governments to stop subsidizing fossil fuels to the tune of $5 trillion a year, which is an IMF figure? That'd be a great place to find the $100 billion and lots of other money needed to kickstart the clean energy markets we need, right? That's a question from Alex Wilkes at the Sunrise Project. I was wondering if any of the panelists would like to comment on that. Leonie, whilst I still have you, I guess it's a form of this divest invest argument, or whether to try and engage rather than just ask people to divest completely, right?
Yeah, and that's always, I think, the dilemma. And also, if you look at all the energy scenarios for also alignment with the Paris Agreement, you still see that fossil fuels play a role. and yes, maybe to a lesser extent, and you see the transition happening, but they do play a role still. So full exclusion of those sectors is not something that will help also the economy to really be aligned with the Paris Agreement. And indeed, our approach so far has been very inclusive. Yes, we have certain sectors that we exclude, but with most of the sectors, we work with them, support them in transition, and really make sure that also the whole economy is getting on that journey to align with the Paris Agreement. And by saying today, okay, we stop, we can't change the economy overnight. So a better and more strategic approach is to help transition, and we really put strong targets in also those ambition criteria that we tie into transaction structures for our clients. So it is not something that is just, okay, it's nice to have. It is really something that is pushing the agenda forward.
Thank you, Leonie. So very much a call for engagement and proactively trying to channel capital towards positive impact that we've heard from you. And finally, Barbara, if you could maybe bring us to a close, how can greater transparency and better disclosure of climate-related risks help us to reset the financial system?
So thanks so much for that. And I think just like, what you've heard also from the panel before, I think what you can't measure, you can't manage. So I think as we have heard on the panel here, there is this urgent shift this urgent need to shift the whole financial system to better respond to it, and also help reduce and manage both physical and transition risks triggered by climate change, as well as to standardize. I think that we've also heard some of the related disclosures, but there's also a need to really start getting more and better information on the extent to which current investments in grid are sufficient, and if not, what is more needed to ensure that we are on a strong trajectory across sectors and geographies towards Paris alignment. I think comes also back to the last question that we've had. So just maybe two quick examples of how to do that. So over the summer, we have been at CPI working to assess really the alignment of new investments tracked in our annual global climate finance landscape. Initial for sectors where there's good data availability, like the power sector and also the light duty vehicles sector in the US. And the analysis is not yet finalized, but what we have seen is actually that several, and in fact, most countries and investor types are not yet aligning new investment with the 1.5-degree trajectories. I think that comes back to Leonie's point that we really got to think about how can we phase out these investments, new investments, at least into fossil fuel activities. And so approaches like that will really help us identify misaligned investments and also inform the taxonomies of what should be funded and where. And I think the second example I'd just like to mention are qualitative metrics, which are also very important in monitoring progress of a broad set of financial carbon climate resilient transition. And we are currently in the process of developing a net zero finance tracker, which is a collaborative data knowledge and advisory platform that's operational both on the global but also at national levels for selected countries to really work towards a more comprehensive assessment of the alignment of public and private finance with Paris Agreement goals. And this is drawing on a huge range of existing public and proprietary qualitative and quantitative data sources of all the different initiatives that are looking at various reference points for Paris environment. And the idea really is to make sense of all the great information that is emerging, that is starting to be disclosed from the private sector as well, but also in alignment scenarios. And I think this will really allow us collaboratively to assess investment and knowledge gaps related to Paris alignment and hopefully set us up for success and for a better action into the future. So maybe just to close, Rhian, I think ultimately, and I think James started out with that early on, ultimately we need systemic change and we need mainstreaming. Mainstreaming clearly is the need of the day. So I think you're seeing encouraging trends. We are seeing also exciting financial instruments and business models, including recovery bonds that I think comes back to the previous question, how can you really come up with opportunities for the financial industry to move away from the fossil fuel side and really kind of invest in the green activities. but I think we're only seeing the tip of the iceberg of what's needed. So really supporting a reset of the financial system towards disclosure, towards better information on progress.
Oh, I'm afraid the tech gods have not shone on us for a moment. We were doing so well, but fortunately we have come to the end of our session. So we will thank Barbara, who's been so rudely interrupted, but also thank James, Leonie, and Dr. Hajjar for joining us for what has been a wide-ranging conversation. So with that, thanks very much, and thank you to all you for listening and for sending in questions as well.